Happy Friday, everybody. Welcome back to Swan Signal Live. I'm here with my co-host, John Haar, as always. And we've got a couple of special friends with us today. Ben Werkman and Jeff Walton are in the house. Welcome, fellas.
Hello, hello. Happy to be here. Happy Friday. We made it.
Happy Friday.
Jeff crawled back up into his chair just in time for this the live spot right here, right before we went live. He was literally on the floor. Jeff, respect, man. I know that you've been working super hard in the long hours. I know Ben just went through this too with the Sequans deal. I can see as being somewhat of a part of that. Got a peek into just how long the hours are, the endless conversations, and all of the thinking and the math and the spreadsheets and everything that goes into working these deals. So, congratulations on the completion of it, and I'm glad you're still alive. Tell us a bit about the deal. Tell us how it came to be, and it seemed to go through really fast. We'd love to hear some more details.
Yeah, absolutely. So I guess real quick, we went public with our reverse merger. We completed our reverse merger last Monday. So that was 9 days ago, 7 trading days ago. And within that time period, we've gotten to definitive agreement on the acquisition of Semler Scientific.
Got it.
To put it in perspective, the definitive agreement of the asset entities deal took, I want to say 3 months. This took about 4 days. So things are accelerating very quickly and identifying opportunity in the space. So last Wednesday in New York, there were some conversations talking about what the possibility of this may look like. And things accelerated very, very quickly. And we got to definitive agreement on Sunday night and announced publicly on Monday morning with an agreement of this potential of this acquisition. So there was a ton of math that went in behind the scenes, so many conversations back and forth with lawyers and the banking partners and on all different angles, and communication internally. The amount of information that was passed in both directions, doing due diligence all day Saturday, all day Sunday, was pretty mind-numbing, to be honest. But ultimately, what this really came down to is thinking about where we're at in the development of this Bitcoin Treasury ecosystem and what the future trajectory of it looks like, and really the importance of having a strong financial team that's ready to build for the future. So thinking about our intentions of issuing a potential perpetual preferred security in 2025, the most efficient form of leverage to put on our balance sheet, not have convertible debt overhang on our balance sheet, to provide investors two unique products in the market: an amplified high growth Bitcoin product and digital credit product in the market. So I think that combined narrative, we're more powerful in strength here. And you think about credit quality and how you calculate credit quality. This is a bit of a situation where 1 + 1 = 2.1. When you think about the credit quality aspect, and you can run the math and look at how much a larger balance sheet actually helps with just general leverage calculations and volatility and risk profiles. So it was a massive win from that perspective, just thinking about the balance sheet side. And looking back to the creation of Strive and our largest shareholder, Vivek Ramaswamy, having his connection in the biotech healthcare industry, connection in politics with the Make America Healthy Again movement and preventative healthcare, there's some real potential synergies there to take the healthcare side of the business and buff it up and amplify the message in the Make America Healthy Again movement, and potentially spin that off into something else greater than what it is today. So there's a big opportunity on that front, leveraging the expertise of the background of Vivek, our team on the M&A side, and then also Ovik Roy, one of our board members that's got an extensive history in the healthcare space, understanding investor sentiment, what people are interested in that space. And I think that overall, it's a massive win for both companies.
Seems like it.
To maximize value and grow in this Bitcoin Treasury ecosystem. And I think one of the major reasons that this was a very productive transaction, is because everybody was viewing this from a Bitcoin lens, not necessarily a fiat lens. And I think that
Nice.
provided a significant amount of value.
Yeah, that makes perfect sense. So we've seen kind of a unwind, a downturn, a correction, however you want to say it, in the Bitcoin Treasury company space in the past few months. We had the big pipe unlock for Sequans, which drove prices down as you know pipe investors were selling shares when they became unlocked. Same thing seems to have happened to Naka um, in the midst of a more general downturn as well in Bitcoin Treasury stock prices. This Ben, I would love to hear your thinking on like where is this sector some called for, like this is the kind of the death of this idea. It's only going to be a few companies. We have this merger now taking place, some consolidation, and we see that maybe that's kind of a path that will be taken. And it's not just one or two or three companies, but maybe it's a smaller handful, and there's going to be a consolidation of companies that are working on this strategy. Do you think there's sort of a minimum effective value or size for these Bitcoin treasury companies moving forward?
Yeah, I think calling what happened a correction is very generous. This has been a pretty solid bloodbath all around. I think people are starting to feel that. These
Yeah,
are
fair.
certainly the moments where if you're any type of an investor in this space, your conviction's going to get tested for sure. But I think that the positive side of where we're at is any froth that was in this market is gone. And a part of that is certainly, the trend really started late June. If you kind of look at the broader macro drawdown in the treasury companies, Metaplanet kind of started drawing down late June. It sort of accelerated through July and through August. And there's been no magic bullet that anybody had to stop capital from rotating out of the sector for that period of time. So now when you look across this industry, you really don't see massive premiums built into these anymore. And a lot of that is certainly going to be around what's been happening in Bitcoin. Obviously, Bitcoin kind of went stagnant and now it's ground down. I think we're just over 110 right now, which, it's a little funny that at 110, people are feeling so bearish on Bitcoin going into historically the most bullish quarter of the cycle for Bitcoin. But that's where we're at. And these are the times where you really have to reset and reevaluate, where you want to be positioned, what types of companies you think have the best strategy to execute over the next, several years, and you position yourself for long-term investments. I've said a few times, the one thing that I think was probably a negative broadly in the market as treasury companies really rose in prevalence is that it kind of undid some of the investing thesis that people had around Bitcoin. We had all trained ourselves to be incredibly long-term in our thinking. We thought in terms of 4-year cycles. And when it comes to now equities that are trading on balance sheets filled with that same asset, right, which should allow them to perform very well over full cycles and over long periods of time, people are applying trading mentality to it. Several of these companies have been around for, 3 months, 6 months, if we're generous for a few of them. This has been incredibly short term, and you're already seeing people calling for it to be over and these companies are dead and the strategy didn't work. And, I think that just tells you where the sentiment is right now. In terms of where I think the industry's going, I think what just happened with Strive and with Semler really is going to pique the interest of a lot of investors. Because before this transaction happened, everyone looked at trading below NAV as kind of this death blow to a company. And what you're seeing now is that when you have an entire industry that's built up around building balance sheets filled with Bitcoin and understanding that there's a lot of benefits to scale in this space, it starts to create different value propositions for those. So I think it'll actually ultimately raise the floor for a lot of these companies, because now the conversation's not going to shift to, well, it's dead and over and this company has no more moves. Now it's going to start on the speculation of, is this an acquisition target? And that'll bring investors in alone on that speculation. So I think that's going to be a very interesting development. And I think it's going to help this industry in general, because to Jeff's point, when you're doing M&A in this space, it's a very different mentality that you're operating from, right? It's not the traditional fiat structures. What you're really looking at is when we combine these companies, one, for the acquirer, are you building up that asset floor, that NAV floor for your shareholders? And on the other side, you're looking at when we combine, do we have more power together than we have alone? If our shareholders are fully on board with this Bitcoin treasury strategy, which most are going to be because that's the entire reason you would invest in most of these companies, when they look at the end result of a transaction like the Strive and Semler, you start to see what they can do in the credit markets that they couldn't do if they both stayed at their respective sizes, right? They're fairly similar sized companies all in. Strive had a little more Bitcoin than Semler did. I think Semler had 5,021. But the combination, when you're getting closer to 11,000 Bitcoin, that gives you a huge amount of leverage capacity that you can now take out to the credit markets and really tailor products into there. I love
So there is kind of that minimum effective size kind of thing. You think it might be around 5 figures of Bitcoin?
I think that's when you're getting into the optimal size. It
Yeah.
doesn't necessarily mean every company is going to get there before they can access the preferred markets, but I think it's ideal. You want to be out there where you can raise at the institutional levels, right? You're raising 9 figures plus in capital through these preferred offerings. I think that's kind of the sweet spot that you want to get to. You know, before I'd kind of said around $1 billion. Probably post raise. If you're $1 billion post raise and you can manage your leverage, that's probably an effective size to be able to go into the preferred markets. So doing these acquisitions is kind of a fast track to that. And I think other companies are going to start looking at it now. I don't think this is going to be the last acquisition you're going to see in this space, but I certainly think it's going to serve as the case study that most of these other companies are going to use when they start evaluating M&A activity and any targets that they may be looking at.
It does feel like the beginning of a trend for sure in the space.
Which might mean we end up with significantly less treasury companies than it looks like we are right now. You know, there's going to be a lot that struggle for the scale, and these are going to be the periods that start to separate these companies. Because I think what you've seen right now is because there's a recognition that these companies need to achieve scale on the balance sheet, there's been a willingness and almost an expectation of massive equity issuance in the early days. You know, the same thing that strategy tends to get most of its heat for, which is using its ATM to build the NAV on the balance sheet and then go out and issue the credit. For most of the startup companies, that's what investors are cheering for right now. For those companies, they want them using the ATM because there's an acknowledgement of the scale. But at a certain point in this type of a strategy, you have to have leverage. Otherwise, you are not a leveraged play to Bitcoin. So if you get to this point, say we flip over into October, you got Bitcoin at 110, we get into the historically most bullish quarter for Bitcoin that you get in a cycle. If Bitcoin runs to 150, 200, and you have no leverage on the balance sheet, you're not going to get the same impact as a company that had that in place before the run started. So I think we're in this critical period of time right now where companies really need to focus on finding ways where they can get at least some levered exposure to Bitcoin on those balance sheets.
John, I'll hand it over to you for some thoughts and any questions you want to throw out there.
Yeah. First, I mean, this Strive Semler announcement was what, 4 days ago? This is super old news. I don't even know why we're talking about it. No, I kid. And you could tell that these guys genuinely love it because number one, they worked so hard to get it done, but then they're also happy to just say, hey, I'll come talk about it. So yeah, great to see the genuine interest and passion from you guys. What else to say? Yeah, I think the point about zoom out for Bitcoin and things that we've been saying for many, many years, however long you've been in Bitcoin, has been lost with Bitcoin related equities. So I feel like that can't be said enough times. Even if you look at, you know, large tech companies, which have been the best investments in US capital markets history over the last 25 years, they're all going to have some period where they went down 50%. You know, look at Amazon's price history. There's multiple times that it went down by 50% over some time period. And that's a stock and a company that has revolutionized its industry and completely changed the world. And again, it's one of the best investments of all time. So things don't just go up and to the right. And Amazon has even done that after it became a proven company. Like we're talking about an industry that's kind of, built on top of Bitcoin, which is still, I still think it's early, relatively speaking, for Bitcoin. Uh, Bitcoin is not nearly as well accepted as Amazon's business model, right? And then you have this Bitcoin treasury company industry that it's even earlier for. And people are still figuring out, like, we're debating right here. We're saying, like, what's optimal? How many of these should exist? How many in each capital market should exist? What's optimal size? What should the underlying business model be? 4 months ago, MNAVs were here. Now they're here. Like, this is a messy process of price discovery and of markets in a nascent industry. So none of this should really be too surprising. I know we would all love if we could put on a trade and just have it triple in 3 months and, do it again the next 3 months, but life doesn't work that way. So yeah, the zoom out advice is good for Bitcoin, and it's good for Bitcoin treasury companies. And I would just say that is your opportunity, right? Because people don't realize this, then there are going to be people who sit on the sidelines and don't see that there is a company and a management team that has the long-term thesis. They put all the pieces in place, and that is how you find your next good, I'll use the word trade, even though I don't like, definitely not a day trade, but like your next good entry point comes when sentiment has completely shifted and you say, wait a minute, really nothing changed in my long-term thesis versus 5 months ago.
Yep.
And now there's this company with great people, great management team, great strategy that's trading, 70% lower than where it was 5 months ago. There's your opportunity right there. So that's kind of my big picture on this, but I do like the debate of like what's optimal size, business model, how many are going to exist, things like that, because again, we don't know the answer. The market is figuring this out in real time.
I think that there's this desire to always jump way ahead. When we're this early in the process, right, you realize that strategy is the only one doing it at some level of scale. And when you look at the addressable market, you realize that scale they've achieved is absolutely nothing in those credit markets yet. And, we tend to fast forward to, well, how many can there be? And you want to put a number on it. And I look at an addressable market that's in the trillions of dollars, right? And I liked something that Semler said, which was, for everyone that's saying Bitcoin is going to fix the money, fix the world, to do that, you've also got to fix the equities, you got to fix the credit, you got to fix the money markets, right? There was all these other things that you also have to fix. What a lot of these companies are doing is they're embarking on the journey to start fixing the credit markets. And this is the first foot in the door. These are brand new products. I mean, we've only got a couple of quarters of these products even being in existence so far. So to try to look for the saturation point right now before these things have even really got rolling, where we've gotten more of them into the market. Now you've got more corporations that can start applying pressure to the ratings agencies to start looking at these because they're becoming more prevalent. We're at the start line on this leg of the journey. And for all the companies that are embarking on this, they're not focusing on 1 month, 2 month, 3 month type of outlooks in terms of how they're making their moves, because every move you make has to be methodical because you're deploying a strategy that's going to persist for decades, right? Every step you take today is going to have ramifications and compounding impacts over the next 5 years, 10 years, 20 years. And so these companies can't make rash decisions based on temporary market conditions. And I think that's what's missed a lot, is you want management teams to be incredibly methodical about how they deploy this. I know there's a constant tugging of needing to see action every single day, and metrics start to get created that incentivize shorter term execution and shorter term execution. But when you're using an infinite duration asset, you have to approach your strategy differently. And I think that that's a really important message. So I don't think it's necessarily, it doesn't feel good, certainly, to have the froth come out of the market, right? You certainly love seeing the higher prices, but this is where things are going to reset and reground. And I've said this many times, but nobody wants to be a buyer when it's usually time to buy.
Yep.
And based on everything that I'm seeing out there from a sentiment perspective, it feels like we're pretty close to that point. People are in the it's over camp, even on Bitcoin. Meanwhile, we're cruising at 110,000
110K
still,
and
which,
Bitcoin's
a
dead.
year ago we would have been begging for. So
yeah,
it's early. It's very early innings, and there's a lot of game to be played, and this is evolving. And the products that are going to come out are going to evolve. The structures are going to evolve. The types of companies issuing them are going to evolve. And we haven't even got to the general acceptance of just holding Bitcoin in your treasury at some percentage, which I think is going to be one of the biggest impacts out there. These treasury companies that are reinventing these credit markets is massive. That's a massive shift in finance. But the broader acceptance for corporations to say, look, I don't have to go and try to engage in the capital markets and issue securities. But what I can do is take the value that's being created from this company that's had decades of operating to get to this scale, and I can start protecting that.
Mm-hmm.
And I'm going to start holding that value on the balance sheet. I'm going to stop dividending it out and surrendering my capital. I'm going to start holding that and creating long-term value and building that war chest so that I have it available for whatever I need to be next. It's that optionality that's so important, particularly in the age of AI. And I think when that wave comes and it no longer feels taboo for companies to just say, hey, we've got 10% of our reserves in Bitcoin. And, that's our plan. That's all we're going to do. But we've got 10%. I think that's a massive wave that's yet to show up.
I know as an investor, I'd be much more at ease with the company that has a solid chunk of their cash or their savings in Bitcoin. It signals to me that you're a smart manager, and it signals to me that you're going to have a backstop for a long time or a war chest once you see an opportunity to invest and chase. So it will be a standard practice. It will be a best practice at some point. So I just want to emphasize real quick for everyone. Ben made a great point and brought it up at a great moment. We all understand this. Like, Bitcoin is a long-term investment, right? And we are in it for the long run. It's been 10 years, right? I'm still here talking about it, and I still think about it as a generational thing. Like, this is for my kids' kids, and our, on down the line. And when it comes to the treasury companies, you're merging it into this space where it's like, day after day, the morning news talk shows, and then the quarterly reports and all that stuff. And you're chasing it, and the conversation is always happening. The news cycle's there. And it's all relevant to that one number on the ticker, and you're trying to run that thing up. And there's a little dissonance going on in my head too, as we are working with Sequans, between this, over financialized world of equities and trading stocks, and this sort of slow moving iceberg that's going to change global monetary base over a matter of decades and centuries. And it's just a little weird. And so people do need to, I think, go into investments with these treasury companies thinking long-term as well, just as long-term as with Bitcoin. And if you have that expectation, then I think people will be a lot less worried or upset, and you'll allocate more thoughtfully, et cetera. So
I have some math on this, and I think it's helpful to explain. So every single 4-year compound annual growth period of Bitcoin is positive. So if you were to buy Bitcoin on January 1st and 4 years later you were to sell it on January 1st, every single one of those return periods is positive in Bitcoin's history. And that's varied, and that compound annual growth rate has been coming down. But regardless, if you hold for 4 years, there's not a single point in time where if you've held Bitcoin for 4 years that you would have lost money, which I think is a valuable perspective. In fact, like 99.9% of the time, you're outperforming the S&P 500 if you hold for 4 years.
Nice.
So now, when you look at companies that on a Bitcoin standard, there's actually only one company that's been around for 4 years that's operating on a Bitcoin standard, and that's Strategy. And so they've only had 282 periods where they've been around for 4 years. So there's been 282 days where they've been around for 4 years. Every single one of those 4-year return periods is positive. The 99th percentile, the worst performing 4-year period you could have had in MSTR history, is a 31% compound annual growth rate. That's the worst. That's the absolute worst. If you held it for 4 years, that's the absolute worst. Now, if you just look at a 2-year horizon, the 99th percentile is a negative 47% compound annual growth rate.
Wow.
So you've got to like reframe your mind. Exactly what you're saying. Like this, that the math here is super important to look at. If you're investing long-term in an asset, Ben, to your point, that is as a company that's holding the best store of value on the planet, that's taking this long-term view, it's super helpful to take a long-term view if their goal is to accrete Bitcoin for each shareholder and continue to grow that asset base. So um, I agree with the sentiment that's been passed around on all of this. Like you need to be looking long term. And one other thing that you guys hit on here was this concept of how many of these companies can exist. There are 5,800 U.S. insurance companies, all offering the same product. How do you choose which one? Like whichever one's local. There's so much optionality here. We're in the year 1696, like offering insurance on the second boat that's gone across the Atlantic.
Mhm.
Like that's how early we are here. Obviously, information flows like a lot faster, but like there's so much on the horizon that is just going to expand and grow here. And this concept of thinking about these companies trading at a discount to their MNAV, Mason brought up a really good point on our True North a couple nights ago. If you're a fiat-based company and you want to look to add Bitcoin to your balance sheet, let's say you're a company like Costco, and you want to go add 5,000 Bitcoin to your balance sheet 5-10 years from now, and you're like, wait, I can't, if I go buy 5,000 Bitcoin, like the market's going to move on me. What's the most efficient way to go buy the Bitcoin? It's probably going to be an acquisition of one of these companies that's held a lot of this Bitcoin and like grown that Bitcoin over time, because then you get the whole management team, you get the operating business associated with it. And that's likely going to trade at a premium because the business that holds that Bitcoin is going to say no to any bid that's not over and above the value of their Bitcoin, because they have the Bitcoin. They're the ones in power. And I think that's a valuable construct to think about over time. Like worst case scenario, like if your operating business is break even, you have the best asset on the planet. You could just sit on your hands, and the optionality will come to you. You have the
Mhm.
optionality, not anybody else. So despite all the noise and what I think is like 98% negative bot sentiment out there, these companies are actually really strong. And to the extent that the equities are down, it almost doesn't really matter, because if you have the capital, you could still operate in the capital markets. You could take on leverage. Like the equity only matters if you're using it for your issuing to pay your dividends, if you're issuing more stock to pay your ATM, or you're ATMing stock to pay your dividend obligations, whatever that may be. So like we're so early in this landscape. Holding long term, I think, is incredibly valuable, and just having a mathematical framework based on history and where you think this is going is just so incredibly important.
Yeah, right on. And I gave the example of like big tech stocks having big drawdowns. And one of the good things I learned in my finance classes in college, which is I don't feel like is a long list to be honest with you, but one of the things that stuck with me was a teacher. It was like an intro to some sort of finance or investment class, and he pulled up a bunch of 52-week highs and lows for a bunch of big name stocks. And if you look at that, it's a wide range for like all these big companies and, whatever the blue chip you want to pick, like Coca-Cola or some big company that's been around 100 years in a well-established industry. The 52-week high and low range is typically pretty wide. And he just said to the class, do you think the fair market value, and that is a nebulous term, but he said, do you think the fair market value for this company actually hit a low of this and hit a high of this, like based on some sort of real metrics? And I know these are nebulous terms, but most of the kids in the class felt the answer was no. It's like there's a lot of noise here. So I think you just have to remember that. And you don't even have to look at the tech companies to make that point. You could even look at MicroStrategy. Their first buy, they did it at a certain price, and then Bitcoin, I think, fell pretty promptly after that. Then we did get into a bull market, and 2020, 2021 was very good for them. Then it was like 2 years of terrible outcomes and everyone writing sailors' obituaries. And to Jeff's point, if you do the analysis on a 2-year time horizon versus a 4-year time horizon, you get a completely different answer. So yeah, this is, and I'll quote Ben Werkman, you can't borrow someone else's conviction. So in order to have that 4-year conviction, or in order to actually hold for 4 years, you need to have conviction, and you're not going to get that just by listening to somebody else. So these are your opportunities. It's going to be a long-term game, whether it's Bitcoin or a Bitcoin treasury company. And lastly, I will just say, this is something that Swan has been beating the drum on for a while. While we do think the Bitcoin treasury company trend is legit and it's here to stay and the market is figuring out what it's going to look like, our advice for the average person who's not going to follow this stuff crazy is 80% or more of your portfolio in spot Bitcoin. There's just extra analysis, homework, volatility, risk assessment to do when you start playing in these Bitcoin treasury companies, these stocks. So that's been our general advice. You don't have to take it, but that's a drum we've been beating for quite a while, and I think it's just worth repeating.
Now fold in digital credit in there too. That changes your whole frontier, right? Your efficient frontier completely changes. You fold in, perpetual preferred equities or fixed income instruments backed by Bitcoin. You're like, wow, this is interesting.
That is a good point. People are going to have to make the broader asset allocation decision. I have these conversations with clients all the time, and I usually, the first thing I say is, yes, these instruments, all the STR, and then the different instruments that Sailor and Strategy have come up with. Clients will ask us at Swan, what do we think about it for them? My usual first response to them is, this is more of a financial planning question than it is like a Bitcoin question. So you need to start asking questions. What's the client's age, their family situation, their time horizon, upcoming expense needs, what's their existing asset allocation. So you need to start thinking much more like a financial advisor when you're going to say, hey, how much of Stretch or Strife should I own?
This does really throw a lot of that on its head, though, because when you're looking at these products and you realize that with the asset coverage, you're really looking at AAA rated credit, yet you could get average S&P returns by holding high dividend yielding credit instruments. That rattles a lot of people's brains, mine included, when I started thinking about that, going, wait a second, typically what you were looking at was you were allocating passively to the S&P 500, and over a long enough time horizon, you were going to average, 9%, 10% during that time period. Now you've got fixed income products offering you the same thing over collateralized 8-to-1, where, like that changes the way you think, even in that, financial planning and retirement modeling type of a scenario for people that are risk averse, which is kind of hilarious to think that products are being built on top of an asset that most of the world views as highly risky. And it's giving them stability through these products, right? You're stripping out that volatility. You're still giving them the benefit of that compound annual growth rate. You're over collateralizing these products in a massive way where Bitcoin would have to be catastrophically hit before you're in a risk situation. I mean, it changes the way people are going to plan, but there's going to need to be a lot more understanding and acceptance of these products. But to your point earlier, John, I think that's really good advice. Bitcoin's the foundation of what makes these companies work as well. So I don't think you could find one single company in this space that's operating a Bitcoin treasury that would discourage anybody from going and holding Bitcoin themselves. When you're these companies, you view it as the most valuable asset in the world. It's what makes all of this work. So it is the foundation. And I think that that's important for people to evaluate as well. It's always interesting to go out the risk curve when it feels like everybody's winning, right? That's the problem, is there's a lot of emotions that are involved in trading in particular. And it's what causes people to rush to the areas that are getting the most attention and the most noise. The hard thing to do is to be the contrarian and to find the entries when everybody else has lost faith. I mean, for Jeff and I and most of the guys that were in True North, that was a part of it. Like we all found the opportunity with strategy very early. And we were incredibly fortunate, but that doesn't mean that it wasn't a rough ride. I can't imagine Sailor was having a lot of fun having his obituary written and having people putting headlines out about how he bet it all and lost, right? I mean, it was not a great period. And when you're holding it, it does force you to continually ask the question, do I believe in this thesis over the long term? Do I think what they're implementing in their corporation is going to be able to provide me outsized returns relative to Bitcoin over that period of time or not? And the hardest thing to do is just sit on your hands during the time where everybody's telling you you're going to lose everything. And I think that's tough. And now it's gotten more complex because in the early days, at least strategy, the model was very simple, right? They had deployed cash at first. They had that one secured loan that one made me nervous coming from a distressed credit background because I know you give up some of your own future outcome because volatility happens and that can cause issues with secured debt. But then they just went to convertible bonds and it was very simple and you could kind of follow it. Now you have a lot of very complex financing structures that are coming out, particularly with companies that are getting off the ground. And that makes these very complex equities for investors to understand, particularly in the early days. And I think that what a lot of people are probably learning at this point is that when you get these big announcements of all this capital being raised, if you don't understand the structure of that financing, it's best to just wait for things to settle, right? Let that transaction close and be out there and settle where you can get comfort now that you understand all the mechanics that are at play. Because there's a lot of complexity that comes with financing at this scale, tons. And I think that's been one of the things that hit the market. And I think that's probably what contributed a lot to hitting this sentiment is there's just so much gray area out there in terms of the understanding. And you got to figure out now you're reading new types of SEC filings. We got really good at convertible bonds and tracking the pricing periods. And now pipe financings are entirely different than that. And now you've got Bitcoin denominated bonds out there. Like there's a lot of things coming into the market and it makes it a more complex strategy to distill for investors. So yeah, Bitcoin's the foundation. If you want to take that, portion at the top and try to speculate and try to outperform Bitcoin, that's up to the individual investor.
I'll just add one more thing, Brady. I think you guys are spot on, accurate about it. Kind of flips the whole financial planning, asset allocation question on its head. If you can do one of these STR vehicles and get what is normally a historic S&P 500 return, I think that's accurate. And I think, Ben, you even added a caveat when you were going through this. There is still a ton of education and acceptance that has to happen before a large number of people actually start doing that. And you just made me think of an analogy, which is I'm always shocked at this stat. With gold's recent run up this year, so all these time periods, year to date, 1 year, 3 year, 4 year, 7 year, 20 year, 25 year, gold has outperformed the S&P 500. So you could look at that and you might think if someone told you that, hey, gold outperforms the best stock market in the world on this many time periods, shouldn't a ton of people just be buying gold? You can just buy this yellow metal and not deal with all these other considerations. But even that's not really happening, right? Like it's hard to get Wall Street.
That wasn't true 12 months ago, though, right, John?
It wasn't true 12 months ago, but even 12 months ago, like there were a lot of time periods where gold outperformed.
Okay.
Yep. And I will make that's a good point, Brady. But I will make the prediction that I don't think financial advisors and traditional TradFi people are going to be like rushing into gold now. Like I guess my point is there is so much inertia in place for investing in passive vehicles like the S&P 500 that even though I believe you guys are technically correct that this should cause alarm bells to go off in people's brains about, wait a minute, I can get 10% on this vehicle with these features. I just think that's going to take a long, long, long time to actually show up in a meaningful way on people's radars.
Can I double click into this just a little bit? Just something that I've been working on last night and it's like top of mind. Somebody made this post about, the probability of Target going into bankruptcy. Target, the company, going into bankruptcy at a future point in time. Target's sitting on $57 billion of assets and they got $42 billion of debt. 2 years ago, they issued $1.1 billion of debt with a 30-year maturity at 4.5% interest. Okay. That is insane. Like with the level of just disruption in the market with Amazon, AI, technology, Instagram, TikTok, like how people are consuming, changing like everything. That's so much risk that it was sold. Like that they sold 30 years of risk at 4.5% interest like 2 years ago. It's just like absolutely insane. And then I was diving into it deeper on Bloomberg, and there's just zero liquidity. Like if you're holding this instrument and you got an inkling that, hey, Target's not doing so hot, like you can't even sell it, which is an issue, right? Like that's a huge issue. And you think about like where we're at with like the population in the United States. You've got all these boomers heading into retirement. They're starting to lean on their bond portfolios, but we're also going through this just like massive disruption cycle everywhere on the planet with AI and technology and all this stuff moving. This becomes like this is a crisis. Like the retirement crisis is like upon us the next 20 years. Like if this happens broadly, like I know for a fact, this isn't the only bad, I'm not saying it's a bad bond, but potentially bad bond out there. There's probably hundreds, if not thousands. And what's the solution? Right? Like what happens with all these boomers get to 80 and all these bonds go bust, and there's actually way more risk in them than like was originally priced, and they're managed by these bond fund managers that have zero incentive to like actually have a more robust portfolio. Like I just think there's an event brewing, I think, on the horizon. I think risk is just massively mispriced globally, with a lot of these physical instruments that were sold on long horizons at old interest rates and different risk profiles. And I think that's just something that's brewing, underpinning where this solution, this Bitcoin-backed digital credit solution, is coming to play. So I'm pulling on that thread, and every time I pull on it, I find something else where I'm like, oh my God, this looks like so mispriced relative to these perpetual preferred securities that are 8x over collateralized. Like they actually have the money. This isn't a bet on future cash flows. Like they actually have the money, and that money is growing faster than any other asset on the planet. And I don't have to take that future cash flow risk. And that is just, it's a novel concept. It is going to take time to kind of infiltrate the market.
So this is my old world, by the way. I'm a former fixed income portfolio manager, investment grade specifically. Target was in our investment universe. As far as I know, it's still rated single A, which is
investment grade.
Definitely investment grade. It's not even triple B. I think it's single A, which is thought to be like a very solid investment grade company. I just pulled up the stock chart. It's down 43% in the past year. And I have to tell this one thing that it's one of my favorite things I ever learned from 13 years working at Goldman. In 1997, two companies issued a 100-year bond at the same time, JCPenney and FedEx. And they issued it at basically the same coupon. They were both like around 7.5. So what that tells you is the market in the year 1997 thought that both of those companies had the same chance of being around 100 years later.
That's wild.
JCPenney obviously went bankrupt. We owned it in a few portfolios. I should clarify, we managed money for insurance companies that often gave us a portfolio. So it was not my colleagues who bought JCPenney and thought it was going to be great. You inherit a lot of these securities. But I will never forget that the market does a horrible job of pricing risk out over the long term. And another one that was classic that we had to work through that went bankrupt was Bed Bath & Beyond. To Jeff's point, when these securities were first issued, people were like, sure, this company's going to be around for 30 years. It's rock solid. People go there all the time. And Target, that was the feeling just 2 years ago when they issued a 30-year bond at whatever Jeff said, 4-something%. And you just look at how the risk assessment can change so dramatically in 2 years that you fast forward again 5 years from now and a lot could change.
Chuck's notes, don't invest in retail companies long-term. Got it. Okay.
Well, imagine pricing risk in today's environment, right? You go back to the 90s, things felt fairly stable. You didn't have this crazy innovation curve that you were looking at. You don't have countries like the US with complete runaway debt. Like we're hitting this weird period in time where there's so many macro risk factors that can impact all of these entities in one way or another. And I think that the pricing of that risk is going to be very difficult. Doing anything very long-term is going to be tough unless your company's taking the bet that all of the shenanigans that are going to come with that instability is going to result in money printing to try to plug the hole and fix the problem, right? Which is the trade that most of these treasury companies are now taking, right? They're effectively taking the carry trade on Bitcoin versus the US dollar. So if you believe the US dollar is going to perpetually devalue and probably at a faster rate, and the path that we seem to be on, well, I want the other side of that trade. I want something that's got defined scarcity, known scarcity, fixed cap supply, 21 million. Doesn't matter how many dollars you print. It doesn't matter if people even want there to be more Bitcoin. There aren't going to be. And that is an asset that you can build for decades on. All the other companies are in a position where you are going to be constantly fighting disruption. AI is going to be a huge impactor and disruptor out there in the market. The speed at which people are able to reinvent businesses now with the tools at their disposal is massive. So almost nobody's safe. And a lot of these big companies that are the household names now also have the overhead that comes with decades of building those businesses, where you can be disrupted by someone that comes out and offers something leaner. So, I look across the investing universe and I have a really hard time finding companies I have confidence in 10 years down the road. It's getting incredibly difficult. And you can't see what's necessarily going to be here 10 years, 20 years from now. But what I can bet on is that we're going to continue to play games with the money. We're going to try to keep people as consumers as much as we can, which means we need to make sure that they know that their money is worth less next year. So they better spend it this year if they want to acquire things. And I'm going to take that bet all day long right now, because that feels like one of the only certainties that I could bet on.
Yep. It's a very, very weird time in the history of humanity right now. It's the culmination of all these exponential technologies that we've developed over the past century. And of course, those built on other technologies that exponentially improved human life and experience. And with AI coming online and Bitcoin, and the internet itself, all of these things are stacking up on exponential technologies on top of exponential technologies. It's going faster and faster. Ray Kurzweil wrote a book in the 1990s called The Singularity is Near. And he has been with Google for a long time now, working in their AI stuff. And the idea they had, and he actually called it, like, timing was amazing. He said by 2025, I think he said AGI by 2030. And like retail level AI stuff like we have now by 2025. So he's pretty close there. But he called it a singularity because we don't know what's next. We don't know what's on the other side of this. I mean, it's all so much up in the air. That's why Bitcoin is so important to have. It's a bet on a system that we know works and we know can work through chaotic times. We can rely on it to work in a distributed way. No one can mess with it, even if there's chaos around. So Bitcoin is a safe harbor, right? Buy some Bitcoin, stash it away. We don't know what's coming. We just don't know what's coming. And it's happening so fast. Should be very interesting. You'll feel a lot safer, I think, if you have Bitcoin and not treasury companies, Bitcoin. The real deal.
Brady, I feel like that could be a good lead in. Should we play that short clip of the Lightning developer talking about quantum risk?
Yeah, we can talk. Let's see. Actually, I don't think I uploaded that. Let me do that real quick.
The other one that would be good would be that housing chart. So you can see
so
the
we can talk about it. Yeah, we had some
good
good macro stuff here. All right, yeah. I mean, there's signs kind of all over the economy. Jeff was talking about kind of credit and bond markets, but the data coming out of the housing market has been alarming. We talked about some of this last week, but in this chart here, John, I'll just let you take this one. Actually, let me go get that video queued up.
Yeah, there's a lot of different ways to take this one. There's obviously a monetary and economic element that you could talk about here. Like, this is another way to look at fiat debasement, and all different players in the market are going into a more scarce asset than fiat and going into an asset like housing. And that's individuals, that's, boomers buying a second home, that's investment funds that do this professionally, developers, et cetera, et cetera. You could also look at this socially, which is something I've definitely been starting to think about more. especially as the New York City mayor race gets closer, and you have to wonder why people are willing to vote for a candidate that several years ago I thought never would have had a chance in any city in America, let alone the biggest city in America. I try to put myself in the shoes of someone who doesn't own a home and is 22 years coming out of college, and they're saying, hey, I don't see myself being able to afford a home where I grew up in until I'm 40 or something like that. And that wasn't the case for my parents. And so there's definitely a social element to talk about here. But just to give you, like, that's long-term trends, but let's just talk about the last 5 years for a second. There's a really shocking set of statistics here that came from Fannie Mae. And they said to get back to home affordability to 2016 to 2019 levels. So they're basically just saying, let's get home affordability back to pre-COVID. And again, I don't think anyone would point to that period of like, oh, this is great, homes are super affordable, right? Like, it was a problem then. It's just gotten so much worse since then. And let's just read this real quick. The median price of a single family home would need to fall 38%. Median household income would have to rise more than 60%, or mortgage rates would have to fall by 2.35%. So they're saying
2.35%.
Oh, sorry, not by 2. They would have to fall to 2.35% from 6.5. Thank you, Ben. It is significantly crazier than what I said. And those are or. It's not all three of those things would have to happen, but you can see those numbers. I don't think anyone is forecasting any of those three things to happen. But that's one of those three things would need to happen in order to get back to 2019 levels. So, I mean, you're seeing fiat debasement, fiat games play out in many different ways, and you can see it in housing.
I mean, that's alarming when you see that. You've got a real disconnect when the median income can't afford the median home price. That's a real problem. And I know we get in this range where we talk about volatility as it pertains to things like equities, and we go volatility is vitality. That doesn't apply to the everyday American's standard of living. You don't want that type of volatility out there where every year you can just afford less and less and less. That is not vitality for people on Main Street. And I think that that's a real problem that I don't know how they're going to fix. We're in this weird period where you've got housing prices are at these crazy highs. Now you've got rates coming down. And so you're expecting that that's probably, the cheaper money gets to borrow. That's probably going to push housing prices up even further. You've got the tariff games going on. That's going to impact the building industry. There's talk of getting declaring an emergency on home affordability. We don't know what the impact of that's going to be yet and whether that's going to have any impact. Like we live in a very privileged part of society where we all get to talk about investments and holding on to assets like Bitcoin. But when you see charts like that, you realize just how hard it is out there for the majority of people, right? We get to have these discussions and they're fun for us. Most people, you've got to pick up another job to plug that gap. That's a tough gap. So people are struggling, and
we showed a chart.
They're going to have to find a way to correct that. But when you see those gaps on all those sides, with how far rates have to come down, with how high incomes would have to go, with how low housing prices would have to go, that's rough.
We showed a chart last week, just real quick, Jeff, a chart last week that showed the top 1% has now crossed in terms of total wealth, the middle 60%. So the 20th to the 80th percentile, the 1% now owns more wealth than the 20th to 80th percentile. Yeah.
But I think, and we can tie anything back to Bitcoin, of course.
Well,
but
fiat
it does
money is
tell
definitely
you
a driver of that for sure.
The value when you have the ability to opt yourself out of that system that's devaluing all the value you're creating from your efforts and your time, which is by far the most important asset that you have. When you're putting that time in to create value to provide a better life for yourself or your family, you have to be very methodical about where you store that value. And if you look around and you don't see these games stopping, and you think they're just going to keep pulling on levers and finding ways to massage metrics and to making things look like it's on the right track, at a certain point, you have to save yourself from that system.
Yep.
And luckily, we live at a point in time where there's an asset that allows us to do that now. That's accessible worldwide, not just in the US. I mean, if we look at these statistics and we think things are getting bad in the US,
Right.
look around the globe. It's not great. So I do think that the faster people can educate themselves and learn how to protect themselves from these outcomes early in their journey, like young people coming out of high school or that are in college, learning these financial lessons and understanding the games that are being played is going to be what sets you up to be able to put yourself in a position to have that stability in your life that a lot of people just are not going to see.
Yeah, one strange other additional element with this housing conundrum is the tax architecture and the structure across different states and different places associated with housing, which just makes things even like in magnitude more complex in every one of these locations. Like in California, your tax basis is a function of when you bought the home. So you've got all these homes that have just rocketed in value and nobody wants to move anywhere because they refinanced at lower rates and they literally couldn't afford to buy anywhere else because their tax basis would reset from their house that they bought in 1995 to, buying the $2 million home in 2025. And they like literally are stuck. So it's so strange. You could go walk down in like Hollywood and you'll see like a $6 million house and then a $3 million house next to it. But the $3 million house is like total slums. Turns out it was purchased in 1995. And the person living there is like, I love LA, but I literally can't go anywhere because I couldn't afford to live anywhere else. And that's a problem. And then you've got the tax revenue component. So you've got all these states that have progressive taxes on houses and housing, where just where I was living in Seattle, like we moved in this neighborhood in 2021 and we got a lot of resentment from people that lived in the neighborhood because we were these young spry kids that just bought a house. And there are a bunch of these people that had these homes for 30 years that were just pissed off because the taxes alone were pricing them out of the neighborhood because of all this tech value that's come into Seattle with Amazon and Microsoft. And that's getting complicated. And then if you have this situation where like housing prices fall, like the tax revenue is going to fall with it. So now the states have a problem. And that just shows the need for these states to be thinking about like, what is the state risk? Like, what is your revenue risk based on all of these different situations? And Bitcoin could be a stopgap if you had a situation where your housing revenue falls because all the homes collapse by 20% or something like that. So these are really, really big problems that everybody can be working on. And I think they're going to come to fruition here at some point. It's like all of this stuff is bubbling.
It is. It's all bubbling. Elon Musk is getting onto this end here. He comes out of the woodwork like once a year with an anti-fiat tweet. No, you can't just print money infinitely. While true, print money. Yes, this is it. It's. I mean, to me, this is the underlying cause, right, of all of these things that we're talking about here and these worrying housing metrics and stats and other parts of the economy as well, especially the wealth inequality. I think underlying there's many causes that contribute to those numbers, right? But to me, underlying all of it is the rigged game that is fiat money, makes the rich richer, makes the poor poorer, gives the control to the rich people, right? And that's just that's the playing floor, the field that we're all on is already tilted, and there's many more things on top of that, of course. But if we can level that playing field underneath, then those middle 60% and the rest of us will have a lot better chance competing in the economy. So buy Bitcoin, do your research on the Treasury companies. If you want to invest in them, just know it's a long-term play. This is a new space. We're figuring it out. The market's figuring it out. So you need to, establish your thesis, grow some conviction, and just commit for the long term, just like you've committed to Bitcoin for the long term. So that's, I think, the takeaway for investors here. Great call. Thank you guys. I really appreciate your time as always. Jeff, have a good weekend. I hope you get some sleep. Likewise. I will let you guys drop off and I'll wrap things up here.
All right.
Okay.
Take it easy. Thanks for having me.
That's a good one.
See ya.
Yep. All right, everyone. Thanks so much for joining us again this week. We'll be back next week on Swan Signal Live every Friday. Me and John, and usually a couple members of the Swan Private team. And on some days, we are fortunate enough to get some excellent guests to join us like we did today. I will leave you with some thoughts about Swan and Bitcoin. Let me see if I can actually pull this up. Make this big. Man, Restream is struggling today. All right, so Swan, we focus on building strong relationships with our clients, and we really partner with people for the long term to help them build generational wealth with Bitcoin. We have Swan Private, which is basically partner you. We pair you with a Swan Private rep, and they will be with you on the entire journey to building that generational wealth with Bitcoin. We also offer Swan Vault, which is our advanced Bitcoin cold storage. It's a 2 of 3 multi-sig cold storage solution for your Bitcoin. You have complete control over your Bitcoin. It is self-custody. It is geographically distributed, so you have keys in different places to help protect against theft and loss and hacking. And you also have a partner in Swan to help you make sure that everything is set up properly. And we're there with anytime you have questions or need help. Same thing with Swan IRA. You can put Bitcoin into your retirement portfolio, the best performing asset of the past decade, 30% CAGR. That seems to be continuing forward, and would be a good idea to check out